time to focus again on oil. We did see the price of crude going above $88 this morning. Iran's foreign minister called for an oil embargo against Israel. Oil up almost 2%. This may be a sign of an escalation of the conflict. We are joined by Bob Dole. He is Chief Investment Officer at Crossmark Global Investments. Bob, thanks very much for coming on the show.
Good morning.
We know that this horrible conflict doesn't directly affect any oil-producing regions, but is there a risk to crude supply here?
No question there is. That's part of, as you just reported, why oil is up. The fear of it alone raises the price of oil. Look, practically speaking, if this is just as horrible as it is, the small part of geography that has been talked about for the last 10 days, not a big deal. It's not a big a GDP area of the world, and oil is not really important. But if you widen it just a bit, bring in Iran, for example, all of a sudden oil is front and center, and that will make or break the economy as well as the markets.
Could we turn to inflation? Your take has been that the easy part of taming U.S. inflation is now done, but the hard part is ahead. What do you mean by that?
So inflation headline numbers, as you know, in the U.S. peaked at 9% year over year, down running around 4% as we speak. My argument, 9 to 4, is the easy part compared to 4 to 2. Remember, the U.S. Central Bank is saying, we want 2, and we'll do what's necessary. That's a lot easier said than done. If the Fed is insisting on 2, they've got more work in front of them. It's not going to just happen because we wish it. It will take a noticeable slowdown in U.S. growth, perhaps a recession to get us to 2. So I think the hard part's still in front of us.
That's interesting. Do you think there is complacency among investors over the progress in defeating inflation?
There is, in my view, prior to the Middle East flare-up, I think the consensus, certainly at the high on July 31st, was, okay, progress on inflation, it'll come down to 2, the economy's okay, earnings are bottoming, why worry, go buy some stocks? And I'm not sure it's that simple. The Fed's going to have to make some tough decisions. If they, to repeat, insist on 2% inflation, they've got a lot more work to do, probably will strangle the economy and have a noticeable slowdown, if not a recession. Conversely, if they're satisfied with 3 or 4, we could have the so-called soft landing.
I don't know if you remember that Saturday Night Live sketch about Tunas the Cat who could drive, but he always crashed. And our central bankers like that, they nearly always generate a recession.
Yeah, most of the time it happens in the U.S., as most people count, of the 7 last attempts, 5 have resulted in a recession. So the odds are not great. To me, it's like threading the eye of a needle. That's what the Fed has in front of them. But the size of the eye continues to shrink.
I like that. That's a great metaphor. You have some equity selection tips for us, things people should look out for. Earnings predictability is near the top of the list.
Yes, earnings predicted. We're in uncertain times. We don't know where the economy is going. We never know, but I think uncertainty is higher than usual. So I want earnings persistence, earnings predictability, good cash flow characteristics, and reasonable valuation. If the market's going down a bunch, those stocks will go down too, but they should go down less. And if the market goes up from here, those stocks will certainly participate.
Are there other industries you're gravitating to right now that offer those characteristics?
Yeah, the HMOs fit that bill. Many of the software companies do, just don't overpay for it. There's a lot of controversy in energy and banks. Energy, I think, among the cyclicals, that's one you have to own, not just because higher prices, but because more capital discipline in how these companies are spending their money. And then the banks, they're awfully cheap. If we have a recession, they won't do well in the initial phase of that, but I think their balance sheets are in reasonably good shape if noticeable slowdowns in front of us.
You said HMOs. You mean the big healthcare companies like United Health or Yes,
healthcare service and providers, absolutely. United Health, Elevance, Cigna, that group.
What about the yield plays like utilities? Are they something you'd avoid with this move up in bond yields?
Still cautious on those for precisely the reason you say. They are so interest rate sensitive, and believing that the path of least resistance out the curve is still to the upside. I'm not in a hurry to run out and buy them. They've had a rally on this 10-year U.S. Move down from that 288 of 2 weeks ago to 263 recently. Now as that yields move back up, those stocks are struggling again. I'd be careful until interest rates peak. Now,
about a year ago, you say, we got to a year ago, we were at the bear market bottom, about a year ago. Now, 1 year later, only about 44% of the S&P above their 2-day moving average. So does that mean we've had a narrow market rally?
It does. That 44% above the 200-day moving average. A year into a new bull market, that number is normally in the 70s or the 80s. So participation's not been good. And you know, in the U.S., while the stock market itself, the S&P 500 is up a low double-digit percentage, without the Magnificent Seven, that number's not far from zero. And if you look at the average stock, the Russell 3000, the median there is actually down year to date. So it's been a very concentrated market.
If your brother-in-law came to you and said, hey, Bob, I found a great office REIT, would you be interested at all?
Probably not. I think the jury is still out. It will take more time. Now, if you give me the right price, I guess I might hold my nose and buy it. But on the face of it, I'd be cautious.
We'd better jump. Bob, leave us with a final thought, would you? In the next, is there something investors are missing right now in the market, or is there a myth you'd like to explode?
I still think there's a little bit too much complacency, that inflation will come down and the economy will be okay. I'm not sure we can have it both ways. So don't call me bearish. I'm just cautious. I prefer S&P 500 4,200 where we were a couple of weeks ago to 44 or 46 where we were on July 31st.